Class is in session. Welcome to Finance University, the only school where the tuition is free and the degree actually pays you back. I'm your Dean of Dollars, and today we're going to perform a forensic audit on one of the biggest ideas in modern finance. Every single investor, whether you're just starting out or you're managing a $1 billion hedge fund, you face the exact same question. It's not really about picking that one magic stock. It's about building a winning team of stocks. So how do you put together a collection of assets that gives you the absolute best return for the amount of risk you're willing to take on? For the longest time, the answer was, well, pretty much a glorified guess. But then, in 1952, everything changed. A young grad student, a guy named Harry Markowitz, had an idea that a Nobel laureate would later call the Big Bang of finance. He totally flipped the script, moving the focus away from just individual stocks to the portfolio as a whole. And this right here was his big idea, modern portfolio theory, or MPT for short. It's a framework for building your portfolio using hard math, not just your gut feeling. And here's the absolute key. It changed how we define risk. For Markowitz, risk wasn't some fuzzy concept of losing money. It was a specific, measurable number, the variance, or the volatility of your portfolio's total return. Think about it like this. On the left, you've got the old school way. Just buy stocks you think are good and, hope for the best. But the MPT way, over on the right, it's about building an efficient team. Some of your players are goal scorers, others are solid defenders. They don't all have to be superstars. They just have to work together perfectly to give you the best overall score. It's all about how they move in relation to each other. So this whole team building idea, it leads us to the absolute centerpiece of modern portfolio theory. It's this beautiful, powerful visual that helps us understand the trade-off between risk and reward. It's called the efficient frontier. Okay, take a look at this. Every single one of those little dots is a randomly thrown together portfolio. They're all over the map, a total mess in terms of risk and return. But that solid blue curve, some people call it the Markowitz bullet, that's special. That curve represents the absolute highest return you can possibly get for any given level of risk. If your portfolio is on that line, it's efficient. If it's below that line, well, you're leaving money on the table. Now, watch this, because this is where the magic happens. Look what happens when we add a risk-free asset, something like a government bond. Whoa, that curved frontier suddenly becomes a straight line. We call that the capital allocation line. And this line represents a whole new, superior set of portfolios. Why? Because now you can just mix that safe, no-risk asset with one single perfectly optimized basket of risky stocks. It makes building the perfect portfolio for you so much simpler. So it's a beautiful theory, right? It's elegant, it's mathematical, it won a Nobel Prize. There's just one little problem. When you try to use it in the real world, it has this nasty habit of, well, blowing up. The theory has a massive Achilles heel, and it's famously known as the garbage in, garbage out problem. This guy, Richard Mashad, he absolutely nailed it with this quote way back in 1989. See, MPT needs three things to work. You have to predict future returns, future volatility, and how all your assets will move together. And here's the catch. You have to guess all of them. They're just estimates. And as Mashad points out, the model doesn't just use your guesses. It actually amplifies any mistakes you make. All right, this chart right here, this is our big flashing red lights moment. That solid blue line, that's the theoretical true frontier you'd get if you had a perfect crystal ball. See those messy red lines? Yeah, that's what actually happens in reality. Those are the realized frontiers you get when you try to guess the future with using old data. You think you're building a Formula One race car, but what you end up with is a clunker that barely gets off the starting line. The gap is huge. This is what people in the industry call the Markowitz optimization enigma. The model is just so hypersensitive that if you change your expected return for one single stock by a tiny, tiny fraction of a percent, it can spit out a completely different and frankly bizarre portfolio. It might tell you to dump 80% of your money into one thing or to short something else, which is basically betting its price will go down. The results are just so unstable that most real-world portfolio managers just don't trust them. So what happened? Did finance just throw its hands up and go back to reading tea leaves? No way, of course not. The core idea was just too powerful to give up on. So instead, a whole new quest began. A search for ways to patch the holes in Markowitz's original theory and make it actually work in the real world. One of the first major fixes was something called postmodern portfolio theory, or PMPT. And it started by asking a really simple question. what do we as investors actually think of as risk? On the left, MPT says any kind of volatility is risky, whether it's up or down. But PMPT on the right makes a much more common sense argument. It says, hey, investors don't mind when a stock is volatile on the upside. The only risk we really care about is downside risk, the risk of losing our money. It's just a much more intuitive way to think about it. And the innovation didn't stop there. An entire field of research basically popped up to solve this garbage in, garbage out problem. You've got things like the Black-Litterman model, which lets managers blend their own expert views with market data. You have advanced stats techniques like the resampled efficient frontier, which try to create more stable inputs from the get-go. The quest to build a better model is very much still happening today. So where does all this leave us? Well, Markowitz gave us this revolutionary way to think about building a portfolio. But his elegant, perfect theory often crumbles when it comes up against the messy reality of a future we just can't predict. Which leaves us with a final question to think about. Is a robust, stable, pretty good portfolio that you can actually understand and stick with better than a theoretical, perfect one that you just can't trust? That's the bell for today, folks. If you want your financial degree to keep paying you back, make sure to smash that like button and subscribe to join the student body. To keep the latest on here at the university, check out our affiliate links in the description and the pinned comment. It's the best way to support the channel. Remember, we drop fresh knowledge every Wednesday and Saturday. Class dismissed.